Hey everybody, Chris Englebert with Englebert Financial Advisers in beautiful Allentown, Pennsylvania with the weekly QCast update. We are talking about end of the year tax planning. Now, why am I talking about this in October? It's because many times people wait literally till December and they start saying to themselves, hey, what can I do for tax planning for the end of the year? So I wanted to do this video, give you some ideas. The first one up there is tax loss harvesting. Now, obviously, what does tax loss harvesting mean? It doesn't mean you go out in the field and harvest your wheat. What it means that you, if it's a taxable account, and this is for taxable accounts only, if you've taken some gains in stocks or bonds this year, and unfortunately, it's been a tough year in the bond market and the stock market, but if you've taken some gains, you can offset those gains with losses that you may not have realized. So for example, if you sold a stock at a $5,000 gain and you happen to have a bond fund that has a $5,000 loss, you can sell the bond fund, take the loss and offset the gain. Therefore, you are not paying taxes on the gain. We do this all the time. You should really be working with your financial advisor to do this because there's no excuse to be paying taxes on gains if you have some losses that you can harvest in your portfolio. But you also have to know the difference between long-term gains and short-term gains. So if you have short-term gains, tax is ordinary income. If you have long-term gains, the top tax bracket is only 20%. So long-term gains are better to take. But again, you can offset short-term gains and offset long-term gains and help yourself as far as taxes go. Now, the other thing you can do is that unfortunately, if it's a year like 2022 and you have more losses than gains, you can carry forward those losses in subsequent years. But again, if you have any questions, I would strongly suggest doing a call between your financial advisor and your CPA before the end of the year to talk about what's going on with tax loss selling. So it's something that can be done in the next couple of months, and you should do it sooner rather than later. But again, remember, it's only for taxable accounts. The other thing you want to do is you want to review your contributions to your 401ks, 457s, and 403bs. So you can see I have on my screen here that if you're under the age of 50, you can put in $20,500 into your 401k, 457, or 403b. If you're over the age of 50, you can put in $27,000. Look at your pay stub. Depending upon if you get paid twice a month, you still have several pays that you could jack up how much you're putting into your 401k, 457, or 403b. The other smart thing to do is if you're getting a bonus at the end of the year, make sure you talk to your payroll department about deferring that entire bonus into your 401k, 457, or 403b. So one of the things that ends up happening is that any money you put into these plans, it helps with your taxable income. So if you're going to be making $100,000 and you put $20,000 in your 401k, 457, or 403b, your W-2 shows $80,000. So for many people, this is one of the best things that they can do. And you still have some time between now and the end of the year to jack up how much you're contributing to these plans. Finally, the other thing you have to do is, depending upon if you're a certain age, if you're over age 72, you have a required minimum distribution. It's calculated based upon the value of your account as of 12/31. Remember, your required minimum distribution counts towards your total taxable income. So one of the major ideas or strategies that we do for clients is that if they are giving to a charitable organization, is that if you give a portion of your RMD, and let's say your required minimum distribution is $10,000 this year, that's going to show up as income, all $10,000. But if you say give $2,000 or $3,000 to a charity, you then are showing an RMD of only $7,000. So you're reducing your total taxable income. Now, the other idea is that a lot of people are beginning to get beneficiary IRAs. Somebody dies, leaves you as a beneficiary for an IRA, and you have to take that money out of a beneficiary IRA. Well, guess what? That money that comes out as a beneficiary IRA is taxable income to you. So what do? Make sure you offset whatever that amount is that you're coming out of from a beneficiary IRA by putting money into your 401k, 403b, or 457. So these are just some of the year-end tax planning strategies that we do all the time for our clients. If you contact me, we can talk to you about it. But again, the way to really stay up to date on what we're doing here at Englebert Financial Advisors is to download my app by texting Chris E, CHRISE to 36260, and you can download my app and you can contact me. And if you're a client, we can talk about what you need to do as far as year-end tax planning. That's all we have for this week. We'll be back next week. Talk to you soon.